Oil prices have fallen off of a cliff since Donald Trump's Liberation Day tariff announcement. And you likely know that Russia funds its invasion of Ukraine through oil revenues. So, does this mean that the war may be coming to an end? Actually, yeah, it might. But the pathway to such an outcome is more complicated than the media discussion lets on. We should be careful to specify what exactly an end looks like here, and there is some chance that it will elongate the war instead. The interesting thing is not that reducing oil prices shifts the expected outcome of the war eastward. It is that there are two expectations, depending on the timing of war, and what really matters is which shifts more. That will determine whether the duration of the war gets shorter or extends out much further. Let's rewind for a moment. Our story begins with Trump's announcement of wide-ranging tariffs against virtually all countries that import goods to the United States, and some that do not. But as has been our running theme for the past few weeks, liberal trade policy encourages countries to specialize in their comparative advantages, allowing the world to produce more goods overall than what would be the case if trade barriers were universal. Kill that, and suddenly production on all sorts of fronts falls apart. It turns out that there is a word for what happens when an economy contracts. It is called a recession. And that takes us to oil. Oil prices tend to track the economy as a whole, meaning that they fall off of a cliff whenever there is a recession. The reason is not just due to the cut in economic outputs causing a corresponding cut in oil inputs. It is also that consumers, facing economic uncertainty, tighten up their spending. The first thing to fall apart is travel, which means less gas-feeding engines on the highways or in the skies. Pair that with how most producers do not have a short-run ability to adjust outputs, and you start getting a glut of oil, which quickly turns into tanking prices. You will remember this in the extreme from the pandemic, when a barrel of West Texas Intermediate fell from $76 to $24 a barrel, exacerbated by how many people did not want to travel out of, the fear of death. Millennials and above will recall a similar effect during the Great Recession, when prices plunged from $205 per barrel to $63. Now, if that 205 number sounded insane, remember that this was before the shale revolution generally suppressed prices. And some of us may even remember the dot-com bust in the late 90s, which sunk oil from $62 a barrel to $35. Thus, the important relationship to know is that recessions cause oil to take a hit and enter a bear market. Right now, the markets are hedging toward a recession being a real possibility. Just prior to Trump's announcement, Goldman Sachs forecasted a 35% chance of a recession, mostly from the expectation of what tariffs might look like. However, Trump's tariff plan was worse than the markets expected, resulting in Goldman raising its forecast to 45%. That made them the optimist in the room, with JP Morgan putting the risk at 60%. Between oil prices and tariffs, there is just so much ground to cover regarding the global economy. If only there were a convenient way to track it all. Wait a minute, there is. Because today's sponsor, Ground News, has us covered. You can customize your news feed on topics like the oil and gas sector, or tariffs, or recessions. Well, maybe something uplifting too for balance. Either way, it just takes a single click. And by going to ground.news/linesonmaps, or scanning the QR code on your screen, you can get 40% off their Vantage plan to unlock access to all of this and more. So thanks again to Ground News for their continuing support of this channel. Alright, we probably need a damage assessment to analyze this properly. Let's go back to those headlines for a second. I know that the knee-jerk reaction to that may be something like, wait, aren't there always people predicting recessions that never come to pass? Well, kind of, though hedge funds usually are not the seemingly omnipresent recession chicken littles. But, like anyone forecasting under uncertainty, they will not always get it right either. With recessions especially, The tricky thing is that if you know that one is coming, your central bank can take steps to stop it from happening. Thus, for a recession to actually happen, it either needs to come as a surprise, or the government willfully takes actions that cause a recession, despite knowing the consequences. We appear to be in the latter category. Trump wants manufacturing back in the United States one way or another. As a result, West Texas intermediate prices dropped by about $10 following Trump's Rose Garden announcement. Keep in mind that this is not the recession price. This is investors hedging against the possibility of a recession. There is some chance that the US economy will shrug off the tariffs. Growth may be strong enough that the economy still expands, just not quite at as fast of a rate as would be the case without the tariffs. A more plausible resolution is that Trump backtracks on the tariffs, as he already has partially done. In any case, as I write this, a barrel of Urals oil, the benchmark for Russian exports, has dropped about $10. What I think is worth stressing here is that the long-run effect will not be $10. It will either be $0 or a whole lot more than $10, depending on whether a recession comes to fruition. For now, though, let's do a back-of-the-envelope calculation. There is an old joke that Russia is an oil company masquerading as a state. That is not true, but it is 30% true. The portion of the Russian government's budget that comes from oil and gas proceeds. Natural gas prices, by the way, are faring about the same as oil since the tariff announcement, so Russia is not getting any relief there either. If we use a loss of about 1/6 of the price as the average between them, then we are looking at a 5% loss for the government's pocketbook. Again, that is back of the envelope. Someone in the Kremlin actually needs to figure out the details. But it is close to the rule of thumb that a $10 drop in oil translates to a $25 billion loss. All we need for our purposes here is a ballpark estimate. And, for now, it is a decent chunk of cash that the Kremlin will need to account for. In the long run, though, this is either a fleeting speed bump for Russia's energy czars, or something that will be a whole lot more problematic. With that, let's turn to the direct effect on the lost revenue to Russia. And, well, this is a simple one. Running a war costs a ton of money. Russia has been pushing an offensive for more than a year and a half. That is a massive drain on materiel and soldiers' lives. Replacing those losses requires running factories non-stop and recruiting more soldiers. The latter is especially tricky because the easiest group to convince to go to Ukraine already left for the front. Every new round of recruitment costs increasingly more than the last. In sum, less money, fewer soldiers, fewer armored vehicles. Thus, the obvious effect of higher oil prices is Russia's expected outcome of the war looking worse. Line go backward. Now, that is unambiguously good news for Ukraine. Nothing about what I say next should make you think otherwise. And if you are not sure about that, recall how Ukraine spent the bulk of 2024 trying to blow up Russia's oil infrastructure. Kyiv's whole goal there was to make the entire industry unprofitable. Well, lower oil prices affect Russia's oil profits in the same way. However, line go backward tells us nothing about what this means for an end to the war, because states should avoid wars in the first place so that they do not pay the associated costs of fighting. Something was blocking the two parties from sitting down at the bargaining table before the oil shock began. In turn, we need to think more about what that friction was and how the oil shock affects it. Oh, and to make matters more complicated, we also need to think about how that fits into the whole Trump peace plan thing. Okay, so let's address the bargaining friction. And good news, we already covered that subject in depth. Russia's offensive puts it on the initiative. For Ukraine to slow that progress, it needs to build a stable front line. But it is hard to do that in the middle of an ongoing battle. Now, to appreciate the consequences of this, let's think about this in terms of our favorite lines. Yep, we are talking about a map here. Russia believes that if its army continues to fight, it might obtain an amount of territory out to, say, here, purely hypothetically. But if Russia stops, Ukraine will have time to work on the defensive fortifications necessary to repel future Russian offensives. In turn, if Russia restarts the war at a later date, it may only be able to obtain territory out to here. To convince the Kremlin to stop, you need the two lines to be roughly equivalent, with the margin of error dictated by how costly war is. More costly, more error. But it seems that they are not close enough, hence the war continues. Now, before getting back to the oil, there are some indications that the situation might be improving on its own. The heart of Russia's offensive began in July of last year, and saw steady increases over the following months. Winter brought a slowdown, and questions about whether the weather was the cause, or if it was a fundamental structural change. Well, 2 more months of data suggest that the slowdown may be real. The counterpoint, though, is that Russia spent March retaking Kursk, after having barely touched the region in February. Combine those together, and it does not seem like much of a slowdown after all. One counterpoint there is that North Korean soldiers were defending Kursk, but are likely not going to redeploy to Ukraine, all while Russia has finally now admitted to using their support. Another counterpoint there is that if Ukraine were smart, it would have been using that time to fortify the Eastern Front and resolve the problem. Thus, the mystery shall persist for a couple more months. Okay, now the conversation turns to how oil prices affect the bargaining friction. The key insight here is that if all sinking oil prices do is generally reduce Russia's ability to win the war, then we are no closer to a settlement. Again, that is because the war does not continue due to Russia's ability to win it. It continues due to the gap between war expectations pre- and post-settlement. If a bare oil market causes Russian power to drop, but the two expectations move back in lockstep, then we have done nothing to resolve the bargaining friction. Actually, there is no guarantee that things will get better at all for those wishing to see an end to the war. Imagine that sagging oil causes the expectation of an ongoing war to fall by a bit, but the expectation of a war, if paused and restarted, to shift by a large amount. Then the friction, as measured by the distance between the two, gets worse. There is possibly good news here, though, if we flip-flop what happens with the two expectations. That is, if the expectation of an ongoing war drops a great deal, but the expectation of a restarted war only sees marginal change, then we finally have made progress. And, fortunately, I think that this last case is the most plausible interpretation of what may happen. Basically, Russia benefits from holding the initiative right now. Higher oil prices offset some of that benefit by limiting what Russia can bring to the battlefield. Over the long run, though, whatever tariff-induced recession that the Trump administration causes will all get sorted out, and oil prices will return to normal. Thus, if the Kremlin were to pause the war and then restart it later, it would not feel the full effects of the budget constraint. The line would still move back, of course, because Russia will be unable to produce as much materiel in the meantime. It is just that the continued war expectation moves more, and thus the peace-inducing effect wins out. The bad news is that I could tell a plausible story where the effect is reversed. If you think that the tariff-induced recession is going to be bad and long-lasting, then the long-run line needs to correspondingly fall long back. Meanwhile, the Russian army may not feel much of a very short-run effect of the lost oil revenues. After all, the vehicle orders are in, and the next batch of recruits already have their contracts and are in training before their deployment. So you might see a situation where the Kremlin feels compelled to fight for a little while longer, use the initiative to take what is possible while fighting at full strength, and then look to settle during a period where shortages are present, but the recession outlook is showing a light at the end of the tunnel. To be clear, I am not sure which way the effect ultimately breaks. Post your own thoughts in the comments below. But as a general reflection on the public discourse regarding the war, we should not spend much time discussing how lost oil revenue hurts Russia. That is both trivial and not directly relevant to peace proposals, because wars are the result of, say it with me, bargaining frictions. Well, it does mean that the West could hold Russia to fewer gains, but again, that part is trivial. Instead, what we should be spending our time debating is which of these does oil have a bigger effect on? Which is a harder question, yes, but also a much more interesting one. As a final thought, it is worth putting this into the context of the Trump administration's peace plan. To get Russia to the bargaining table, the plan calls for threatening the Kremlin with the possibility that Washington will massively increase military aid to Ukraine. However, Trump's underlying doctrine dictates that the United States reorient itself to focus on China. Thus, the Kremlin has called the United States' bluff, and Trump has yet to push back. Given the constraint of wanting to defend Taiwan, one determinant of Trump's credibility to flood Ukraine with aid is just how much aid is necessary to sway the war. To give you an extreme example of what I mean, donating one tank to Carthage would have made a massive impact on a war against ancient Rome. Give one tank to Ukraine, and I am sure that Kyiv would be thankful, but do not expect it to have a tangible effect against Russia. So if you think that losing the oil revenue means that every, say, HIMARS has a bigger effect than before, then it is possible that the United States will now be willing to follow through. However, given the Trump administration's reluctance to budge on the Taiwan issue, there is a second pathway forward that may be more plausible. Another way to incentivize a settlement is to manipulate the costs of war, either by punishing the combatants for continuing the fight, or by rewarding them for agreeing to a settlement. If you want to go with the higher cost route, you could attempt to flood the market with oil. That will further collapse the energy sector, thereby pushing Russia's costs further back and making the Kremlin more amenable to a settlement. However, one does not simply flood the market with oil. Trump has always wanted to expand U.S. production, of course, but American wells tend to have high costs, and therefore are uncompetitive in the current climate. They are also hard to turn on and off on a whim, so this would have to be a long-term strategy. Saudi Arabia is in a better position to rapidly change output, and has the excess capacity to do so. The trillion-dollar question there, though, is whether Riyadh has the incentive to actually do that. Saudi Arabia has positioned itself as a neutral observer of the conflict, wishing to maintain good relations with Moscow as well as the West. The government supports a peace deal, hence the hosting of US-Russia summits. But an outright intervention would be a serious escalation in the eyes of its OPEC Plus partner. If we are looking for a less ambitious goal, higher oil prices encourage Ukraine to push harder for a ceasefire on infrastructure targeting. Russia's focus there has been to attack Ukrainian cities, in a textbook example to drain public support for the war. Ukraine, meanwhile, has focused on Russia's oil infrastructure, trying to target the Kremlin's ability to finance its invasion. But the less that oil is worth, the less attractive destroying oil infrastructure is. In turn, Ukraine gives up less by agreeing to such a ceasefire. And, indeed, Zelensky has begun lobbying harder for it, asking for a pause on long-range drones and missiles targeting civilian infrastructure. Of course, Ukraine's additional interest is offset by a decrease in interest from the Kremlin for the same reasons. Russia gets relatively little and gives up a major component of its overall strategy. The only cause for optimism is that the Trump administration's desire to have any type of ceasefire might take precedence, with Ukraine fully locked into the idea, and the expectation that the additional pressure on Moscow will cause it to follow suit. But that still leaves open the question of where the United States gets the leverage. Thanks again to Ground News for sponsoring today's video. Head over to ground.news/linesonmaps or scan the QR code on your screen to get an awesome 40% discount on their Vantage plan. And if you enjoyed today's video, please like, share, and subscribe, and I will see you next time. Take care.